Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, $67,000 reasons to watch this video. Yeah, I'm going to explain to you how you can still generate up to $67,000 plus, give or take another $6,500 if you are over 50. So $73,500 in tax deductions still available for 2023. All you need to do is watch this video and be self-employed. So this video will focus on the solo 401k. That will be the core of the video discussion. And why the solo 401k is so important is because it gives you the ability, if you are eligible, and that's the first part of the video. We'll talk about eligibility. The second part, we'll talk about how to maximize contributions so that you can generate upwards of $67,000 or $73,500 if you're over 50 in tax deductions. And if you are a Roth lover like myself and you don't want to do everything in pre-tax because you just rather shelter income in the future from tax versus generating current tax deductions, then I got more for you too. There's a way how you can go Roth up to $67,500 or $73,500 if you're over 50. So all you got to do is kind of watch the video, take a little bit of notes, or you don't even have to because you can always reach out to us. We have an amazing team of tax professionals that can answer any of your questions on the solo 401k and help strategize and maximize any potential contributions. So let's get started. First part of the video is who's eligible to set up a solo K. Okay. Basically, there's two eligibility requirements. You got to have your own business. Doesn't have to be a full-time business. Doesn't have to be $1 billion business. You don't have to be creating the next AI type of platform. It could be anything. It could be a sole proprietor. You can sell real estate. You could be a math tutor. You could be a lifeguard. You could be even Santa Claus and Christmas at a mall. You just need to have any business. Okay. And number two, you cannot have any full-time employees in that business other than the owners, their spouses. Okay, a full-time employee is anyone that works more than 1,000 hours a year or 3 consecutive years of 500 hours or more. Okay, but the owners and their spouses are not included as employees. So if you have a company with husband and wife, you can set up a solo K. If it's just 4 lawyers and there's no non-owner employees, you can set up a solo K. So just because the word is solo doesn't mean you have to only be one person. You can have, as I mentioned in my previous examples, you just kind of have no non-owner employees, and spouses are not deemed employees. So if you own 100% of your business and your spouse is your only employee, that's okay because a spouse is not deemed an employee. So now that we know what a solo K is and who's eligible, and any business can set it up, sole proprietor, single member LC, partnership, a C Corp, an S Corp, even a charity. Just have to have a business with no full-time employees other than the owners or their spouses. What is a tax deduction? The tax deduction reduces your taxable income. So in a simple example, if you made $100,000 as a W-2 lawyer and you had $20,000 of tax deductions from contributing to a 401k, you now pay tax on $80,000. Okay, so the deductions reduce your taxable income. And then whatever your net taxable income in, the applicable tax rate would be multiplied by that net income to explain what tax you owe. Okay, so tax deductions are super valuable. They're not as valuable as credits. A credit actually reduces the amount you owe dollar for dollar, and that's the ultimate. But deductions are really important because it reduces the amount you have to pay in tax. So a 401k or a solo 401k provides you for 2023 up to $67,000 or $73,500 if you're over 50 in tax deductions. Okay, number one, you have to have a business that's eligible to set one up, or if you have one, great. And number two, you need income, right? So if you have a great business but you have no income, you can't make any contributions, right? If you only made $10,000 of net income or W-2, you can't contribute more than you earn. So the solo 401k plan is divided up from a contribution standpoint into really 2 categories: the employee deferral and the employer profit sharing. Okay, so the employee deferral, just like if you work at Apple, Tesla, IRA Financial, or if you own solo 401k, in 2023, it's dollar for dollar, 22,500 or 30,000 if you're over 50. So that means if you made 40,000 bucks and you're under 50, you could put all that away in 22,500 into your solo K in pre-tax. And that means instead of paying tax on 40, you're going to pay tax on the difference between 40 and 22.5, which is 17.5. Okay, so then instead of paying tax on 40, and let's say your tax rate is 25%, that's $10,000. Now, instead of that, you're paying 25% on 17,000, which is a lot less, right? You're talking about a couple thousand bucks. So you're going to save all that amount. Instead of giving it to Uncle Sam, you're putting it into your plan, and it's able to grow without tax, which is known as tax deferral. Okay, you can also do employee deferrals in Roth. The advantage of Roth is once you're over 59.5 and the Roth has been open at least 5 years, everything is tax-free. You can pull out all distributions tax-free. Although on the flip side, you do not get a current tax deduction for making contributions to a Roth 401k. So that's the employee side. The employer profit sharing side lets you do 20% of your net Schedule C if you're a sole proprietor or a single member LC, or 25% of your W-2. Okay, it's not the profits of the business, it's the W-2. And you can take that amount, the 20% or the 25% of your W-2, and you would add that to the employee deferral number of 22,500 or 30,000 if you're over 50. And when you add both those components together, you cannot go above 66,000 or 73,500 if you're over 50. So here's some examples. Sole proprietor under 50, make 100K. You can do 22.5 plus 20, 42,500. So instead of paying tax on 100, you're paying tax on 55,500. Big difference. And all that money, that 42.5, excuse me. Also, if it's 42.5, the number is going to be 47.5 reduction. So if you take out 42.5 on 100, you're going to be left with 57.5, excuse me. But that 42.5 goes into a 401k, and then you can invest it in stocks, in real estate, in cryptos, gold, investment funds, your friend's business, almost anything you want. And that money grows without tax instead of going to the government. So it's a double win. You get the tax deduction and you can invest the money as you see fit and hopefully generate tax deferred gains. Okay. Now, if you're over 50, same example, you'd be able to do 30,000 plus 20. So it's 50 out of 100. So you pay tax on 50 instead of 100. And that extra 50K, instead of having it being subject to tax, can be in a 401k, and you could then have that money grow without tax. That's known as tax deferral. Second example, or third example, I should say. You have an S corp. You make $60,000. Let's say you make 60,000 bucks. Okay, under 50. You can do 22.5 plus 25% of 60K. Okay, since all that, when you add the 22.5 and this 25% of 16, since that is under 66,000, you can do all that in pre-tax. Now, the employee deferrals can be in pre-tax or Roth. The profit sharing could also be in pre-tax or Roth. But remember, if you do a Roth contribution, you're not getting the tax deduction. Okay, so the business would, but you would have to pay tax on the after-tax amount. So just beware of that. But on the 60K, you're getting 15K plus the 22.5. So that's 37.5 in tax deductions on the 60. So you can almost shelter everything. Now, if you were over 50 and you made 60K, you'd be able to shelter 45 out of the 60, right? 30 plus 15, 25% of 16. Pretty cool stuff, right? So remember, if you made $1 million, you can't go above the 66 or the 73.5 if you're over 50. So you'd be capped at those numbers. But what I'm getting at here is, listen, you have all this unbelievable opportunities to generate huge tax deductions at the end of the year. Now, a couple other things here. You want to set up the plan in 23 to take advantage of the employee deferral and the profit sharing, but you don't have to. Okay. So I shouldn't be telling you this, but it's true. Thanks to Secure Act 2.0, starting in 2024, if you set up the plan before you file your tax return, so April 15th or September 15th or October 15th with extension, you can still do your employee deferrals and your profit sharing in 24 for the 23 year, only if you're a sole proprietor or a single member LLC. If you have a C or an S Corp, W-2, or a guaranteed payment from a partnership, you have to set up the solo K in 2023 in order to get the employee deferral amount, which is the 22.5 or the 30K if you're over 50. If you set up the plan in 24, all you're going to be able to get is the profit sharing because you are a W-2. And W-2 contributions should be done by 12/31. If you're a sole proprietor or a single member LLC, the IRS understands that it takes time to get your net number off your Schedule C. You have to work with an accountant or a bookkeeper, kind of get all your numbers in order. So they understand you're going to need time, and that's why they give you until you file your 1040, including extension, which is April 15th or October 15th. If you are a S Corp or C Corp, you need to do the employee deferral, the 22.5 or the 30 by 12/31. That's why you want to set up your plan by 23, December 31, 23, in order to get your employee deferrals and the profit sharing. If you don't set up your plan by 23 and you're watching this video in 24, it's not all for loss. You're not going to be able to get your employee deferral, but you're still going to get, the profit sharing of the 25% of your comp. Now, does this have to be your only job? No. You can be an executive at an accounting firm, law firm, business, software company, wherever, architecture firm, and you could still set up a solo K and take advantage of any contributions you've left on the table. So let's do a couple examples. Now you work at, I don't know, let's just say Apple, okay? And you make $100,000 and you don't max out your 401k. Let's say out of 22.5, you put in 10K, okay? And now you have a side business. You sell, I don't know, Christmas cookies with your friend, and it's just you two in your business, and you do pretty well. You made $40,000. Okay, so you each got $20,000, let's say. Then you can do, because you only did the 10 on the 22.5, you still have 12,500 of available contributions for the employee deferral. You can take money from your Christmas cookie business and put it in your solo K. So when you combine your contributions to the Apple plan, contributions to your Christmas cookie company, you add it together, you get the 22.5. So there's still available contributions. Now, contributions are great because they generate tax deductions, which is super important. Now, let's do another example. Let's say your side business does really well and you make $80,000, okay? And let's say you max out your 401k to Apple, you make 100K, you max out your 401k to Apple, and now you made 100K in your Christmas cookie company. For argument, example purposes, let's assume you're the only owner, just to keep things simple. So it's a sole proprietor, let's say. So then you can do 20% of your 100K, giving you another $20,000 deduction. So when you take the 22.5 from Apple and the $20,000 from your cookie company, now you're able to generate 42,500 in deductions. Okay, so even if you maxed out at work, you can still do the 20 or 25% profit sharing from your side business with a solo K. Now, if you didn't max out at work, or you didn't have access to a 401k at work, and you have a solo K, then you can make contributions. But the only income you can use is the income attributable to the solo K. So let's say you make $1 million a year at a company and they don't offer you a 401k, but then you have a side business where you make 60K. You can do the 22.5 off the 60 and the 20% off the 60. You can't add in the money you made from your Apple or other job. The plan is only able to use the contributions from the business associated with the plan. Now, let's say you got some money left over, right? We said the contribution limit is 66 or 73.5 if you're over 50. So here's some more advanced structuring ideas. Let's say you work at Apple, you make $100,000 at Apple, and you put in 22.5 there. And let's say you have a side business selling Christmas cookies, just yourself, and you made 60. Okay. So we know let's say you're an S Corp. Keep it simple. You can do 25% of 60, which is 15K. So now 22.5 plus 15 gives you the 37.5. But we know you still have around $45,000 of available deductions. The problem is you maxed out the employee deferral. You maxed out the profit sharing already. But there's something called a mega backdoor Roth, which lets you go dollar for dollar, like an employee deferral, up to the maximum amount available, which is the 66 or 73.5. So in my example, you did the 22.5 for Apple. You're going to do 15 on profit sharing, right? 25% is 60. So 22.5 and 15 is the 37.5. And now we know the max is 66, right? So you have another 28.5, let's say, to go. You have enough room, right? There's 16 minus 15 is 45. So what you would do then, assuming your solo plan allows for it, and ours does, you have the opportunity to put another 27.5 into the Roth component, okay? And this will allow you to go up to the 66. Now, the Roth component, the advantage is all the money in that Roth component grows without tax. So if you don't need the money, you have other money to live, and this is your savings for your future, then it's much better to save in a 401k, especially a Roth, than in a personal account that's subject to tax, right? Because let's say you took that extra 27.5 and you bought, Apple, Tesla stock, you invested in Bitcoin and gold, whatever. You invest in your friend's business and you doubled your money in 5 years. If you did that in a taxable account, you'd pay capital gains of, let's say, 15 or so percent, or ordinary income of up to 37%, depending on the category of the income. If you did in a Roth, it would all be tax-free. And then when you pull the money out of the Roth, once you're over 59 and a half, the Roth's been open 5 years, it would all be tax-free. So these are the kinds of tax planning techniques we can help you with, where you not only can maximize current tax deductions by way of the employee deferral and the profit sharing, but we can also dump more money in the Roth if you have some extra money left over that can really help you, generate additional tax-free savings that, although it won't give you the immediate tax deduction, it's still going to allow you to generate tax-free growth in a Roth, which down the road, once you're over 59 and a half and Roth's been open 5 years at least, you can all pull it out tax-free. So there's so many cool tax planning opportunities. I think we're the best in the country at this. I've written 2 books alone on the solo K. I've written 8 books on self-directed retirement plans. I promise you're not going to find a company that understands the solo K as well as us. So if you have your own side business, whether you have a plan set up or not, if you have extra money, you want to shelter from tax, generate current tax deductions, or even just save in a Roth, give us a call. You can chat us, you can email us, you can just call us. I mean, we have, as I mentioned, really, really smart, very nice people too, that even though you're not a client, you can have a plan at a different company. Guess what? We're still going to answer your question because we just know this stuff so well. So there's money you don't want to leave on the table, okay? You do this for 2, 3, 4, 5, 8, 10 years, and you can save an extra 10, 15K in deductions. That will lead to hundreds of thousands, if not millions of dollars when you're older, okay? Based off the principles of compounding returns, if you can generate an 8% rate of return, your money doubles every 8 years, okay? So if you just do the math, you're in your 30s, you're not going to retire until your 70s, that's 40 years. You're going to have potential 5 cycles to double your money, okay? And if you can do it all in a tax-deferred or tax-free account, it's the smartest way to save. And if you don't trust me, trust Albert Einstein, who said compounding returns is the 8th wonder of the world. It really is. That's how rich people and smart people get richer, okay? And I'm trying to, educate everyone who's watching this video, just because, unfortunately, it's not a phenomenon that's taught in school. I always give the example. I'm a pretty educated guy. Doesn't mean I'm smart, but I'm educated. I went to university. I went to law school. I even did a master's in tax law. I worked 8 years at some of the largest law firms in the world. And guess what? The concepts of compounding returns and how retirement accounts work, I had to pick that up myself. I didn't learn that in law school. I didn't learn that to get my LLM in tax. I didn't even learn as a lawyer. I kind of had to teach myself. So that's my passion. Hopefully these videos are helpful. Hopefully people are picking things up and making them smarter, more savvy retirement investors. The retirement system is literally rigged in our favor. Okay, it's the one system that works, whether you're a Democrat, an independent, or Republican. It's the one area that, no matter who you are, there is bipartisan support for the retirement system because literally it works for everyone. Okay, it is the best way. It just takes time, it takes patience, it takes consistency, and it takes good habits. That's it. But if you do those things, you will have significant, if not massive, retirement wealth. And if it's tax deferred or tax free in a Roth, it will all help you and your family down the road. So the IRAs, you can only put in, 6,500 or 7,500 if you're over 50. The solo K in 23, you can put in 66 or 73.5, right? It's almost 10 times more than the IRA. When you look at the solo K and even the SEP just gives you the 66K. There's no catch up. But the SEP does not have an employee deferral, meaning everything's a profit sharing. So here's just a simple example to show the benefits of the solo K or the SEP. If you made 100K and you had a SEP or a solo K, say you're under 50, W-2, S-Corp. SEP only lets you put away 25. Okay. Solo K will let you do 22.5 plus 25, 47.5. Okay. Let's say you're over 50. SEP will let you put away 25. If you are over 50 in a solo K, you can do 30,000 plus 25. That's 55. Okay. 55 minus 30. Hey, even my 10-year-old kids can figure that one out. So the solo K is the best, most robust, most powerful retirement plan for the self-employed. There are 67,000, potentially even 73,500 good reasons to go solo. Hopefully, people are watching this video before 12/31/2023. Set up the plan, whether you set up with IRA Financial or Schwab or Fidelity or wherever. Our plan, the reason I think you should set up a plan with us is not only are we going to give you the great tax structuring and consulting service, but our plan is fully robust, which you won't get at a traditional institution. There's pre-tax, Roth, the mega backdoor, as I mentioned. There's the loan feature, lets you borrow the lesser of 50,000 or 50% of your account value. In addition, our plan lets you do traditional investments as well as alts, whereas the traditional institutions like Schwab will only let you buy the products they sell. So when you put it all together, it's a no-brainer. We do all the tax filings, whether it's 1099s, 5500 EZs. We do it all for you. All you need to do is sit back, save, invest, and just watch your money grow. So that's it. Happy holidays. Hope you guys enjoyed the video. Trying to keep them short. I know people got Christmas shopping and holiday parties and a lot of good stuff. So I don't want to occupy too much of your time. At the same time, I do want to make sure everyone understands the opportunity that's still in our grasp to potentially generate tax deductions of $66 if you're under 50, $66,000. Or $73,500. It's monster tax deductions. And not only are you saving the tax, but now that money goes in a retirement plan and all the gains and income from those investments are shielded from tax, or in the case of a Roth, can be taken out of the plan once you're 59 and a half. And the Roth's been open at least 5 years, tax free. Yeah, tax free. So that's it. Thank you guys for watching. Appreciate the support. Thanks for hanging out with me today. Happy holidays, and see everyone again next week. Take care.